We will begin with an introduction to financial statements, followed by detailed sections on the balance sheet, income statement, and cash flow statement. Finally, we will discuss how to interpret and use these statements effectively for analysis and decision-making. At the end of a period, typically a quarter or a year, financial statements are prepared to report on financing and investing activities at that point in time, and to summarize operating activities for the preceding period. This is the role of financial statements and the object of analysis. It is important to recognize that financial statements report on financing and investing activities at a point in time, whereas they report on operating activities for a period of time. Financial statements serve to communicate a company's financial condition to stakeholders, support decision-making, and ensure transparency. They are critical for investors, creditors, management, and regulators. The three main statements are the balance sheet, income statement, and cash flow statement. Each provides a different perspective on a company's finances, position, performance, and cash movements respectively. The accounting equation, also called the balance sheet identity, is the basis of the accounting system. Assets, liabilities equals equity. Remember, the accounting equation is a balance sheet identity reflecting a point in time. The left-hand side of this equation relates to the resources controlled by a company or assets. These resources are investments that are expected to generate future earnings through operating activities. To engage in operating activities, a company needs financing to fund them. The right-hand side of this equation identifies funding sources. Liabilities are funding from creditors and represent obligations of a company or, alternatively, claims of creditors on assets. Equity, or shareholders' equity, is the total of 1. Funding invested or contributed by owners, contributed capital, and 2. Accumulated earnings in excess of distributions to owners, retained earnings since inception of the company. From the owner's or shareholders' point of view, equity represents their claim on company assets. A slightly different way to describe the accounting equation is in terms of sources and uses of funds. That is, the right-hand side represents sources of funds, either from creditors or shareholders, or internally generated, and the left-hand side represents uses of funds. Assets and liabilities are separated into current and non-current amounts. Current assets are expected to be converted to cash or used in operations within 1 year or the operating cycle, whichever is longer. Current liabilities are obligations the company is expected to settle within 1 year or the operating cycle, whichever is longer. The difference between current assets and current liabilities is called working capital. An income statement measures a company's financial performance over a period of time, typically a year or a quarter. It is a financial representation of the operating activities of a company during the period. Typically, the bottom line is net income, which purports to measure the amount that the company earned during the period. The line items of the income statement provide details of revenues, expenses, gains, and losses in a bid to explain how a company earned its net income. In addition to signaling earning power, income is also supposed to measure the net change in shareholders' equity during a period from non-owner sources, that is, before considering distributions to and contributions from equity holders. Income from continuing operations represents earnings from continuing operations before the provision for income tax. Operating earnings does not have a fixed definition, but refers to the difference between sales revenues and all operating expenses. Earnings are determined using the accrual basis of accounting. Under accrual accounting, revenues are recognized when a company sells goods or renders services, regardless of when it receives cash. Similarly, expenses are matched to these recognized revenues, regardless of when it pays cash. Earnings do not typically equal net cash flows, except over the life of a company. Because accrual accounting yields numbers different from cash flow accounting, and we know that cash flows are important in business decisions, there is a need for reporting on cash inflows and outflows. The statement of cash flows reports cash inflows and outflows separately for a company's operating, investing, and financing activities over a period of time. Operating activities include cash flows from daily business operations, like sales and payments are categorized as operating activities. Investing activities include cash used for purchasing or selling long-term assets like equipment or property. Financing activities involve cash flows related to borrowing, repayments, and equity transactions. Analysis tools. This section gives preliminary exposure to 5 important sets of tools for financial analysis. First is comparative financial statement analysis. Individuals conduct comparative financial statement analysis by reviewing consecutive balance sheets, income statements, or statements of cash flows from period to period. The most important information often revealed from comparative financial statement analysis is trend. A comparison of statements over several periods can reveal the direction, speed, and extent of a trend. Comparative analysis also compares trends in related items. Comparative financial statement analysis also is referred to as horizontal analysis, given the left-right or right-left analysis of account balances as we review comparative statements. Second is common size financial statement analysis. Financial statement analysis can benefit from knowing what proportion of a group or subgroup is made up of a particular account. Specifically, in analyzing a balance sheet, it is common to express total assets or liabilities plus equity as 100%. Then, accounts within these groupings are expressed as a percentage of their respective total. In analyzing an income statement, sales are often set at 100% with the remaining income statement accounts expressed as a percentage of sales. Because the sum of individual accounts within groups is 100%, this analysis is said to yield common size financial statements. This procedure also is called vertical analysis, given the up-down or down-up evaluation of accounts in common size statements. Common size financial statement analysis is useful in understanding the internal makeup of financial statements. Temporal, time, comparisons of a company's common size statements are useful in revealing any proportionate changes in accounts within groups of assets, liabilities, expenses, and other categories. Third, ratio analysis is among the most popular and widely used tools of financial analysis. Ratios must be interpreted with care because factors affecting the numerator can correlate with those affecting the denominator. For instance, companies can improve the ratio of operating expenses to sales by reducing costs that stimulate sales, such as advertising. However, reducing these types of costs is likely to yield long-term declines in sales or market share. Thus, a seemingly short-term improvement in profitability can damage a company's future prospects. We must interpret such changes appropriately. Many ratios have important variables in common with other ratios. Ratios, like most techniques in financial analysis, are not relevant in isolation. Instead, they are usefully interpreted in comparison with 1. Prior ratios, 2. Predetermined standards, and 3. Ratios of competitors. The variability of a ratio across time is often as important as its trend. Next is cash flow analysis. Cash flow analysis is primarily used as a tool to evaluate the sources and uses of funds. Cash flow analysis provides insights into how a company is obtaining its financing and deploying its resources. It also is used in cash flow forecasting and as part of liquidity analysis. Finally, valuation is an important outcome of many types of business and financial statement analysis. Valuation normally refers to estimating the intrinsic value of a company or its stock. The basis of valuation is present value theory. This theory states the value of a debt or equity security, or for that matter, any asset, is equal to the sum of all expected future payoffs from the security that are discounted to the present at an appropriate discount rate. Present value theory uses the concept of time value of money. It simply states an entity prefers present consumption more than future consumption. Accordingly, to value a security, an investor needs two pieces of information: 1. Expected future payoffs over the life of the security, and 2. A discount rate. For example, future payoffs from bonds are principal and interest payments. Future payoffs from stocks are dividends and capital appreciation. The discount rate in the case of a bond is the prevailing interest rate, or more precisely, the yield to maturity. While in the case of a stock it is the risk-adjusted cost of capital, also called the expected rate of return. Thank you.